So, should you be investing in a REIT or a single real estate deal? Today, John and I are going to be breaking down the advantages of both and what you really should be investing into at the end of the day. We get this question quite a bit, so we're going to be breaking it all down for you today. Now, if you are looking for a real estate deal and you just can't find any great deals out there, and maybe you're busy building your business, working in your business, whatever that is, maybe you're with family and you're retired and you're really looking for more time freedom, go to fulloutinvesting.com and you'll find out a little bit more about a sample deal that we've done in the past and moving forward, what you can expect when you invest with Faris Capital Partners. Go to fulloutinvesting.com. Hey, John, it's great to be here with you.
Great to be here, Mark. Gosh, what an exciting time. We just closed on a new deal and our full out 28-day transformation is in full swing. In fact, I'm heading to see the property later this week. Now, this episode will probably come out. I've already gone and come back home kind of thing. But I just love getting on site and seeing all that action and activity, right? We just took over the asset literally a week ago and we already have roofs being replaced, painting, in process. The fascia boards have all been replaced. New lighting has already been installed. We've got work happening on the amenities. And so, it's just so cool. And I think such a big part of what makes us different at Faris Capital Partners, that way we attack the deal on day one with that goal of adding as much value to the current residents as possible. I think so much about these residents and, the experience they often have when the new operator comes in. And what usually happens is not a lot changes except for the rents, right? And so, having residents coming by and saying, oh my gosh, I'm so excited to see everything you're doing, just trimming back the palm trees got them excited, right? Because it just aesthetically looks nicer and they just feel better coming home at the end of the day of hard work. And this property is in a pretty small town, and we strategically chose this town because of the growth and just it's a very charming city, has a lot going on. It's a high growth area because it's affordable for retirees, and so just that ability to come in and make a really great living experience for a market that's candidly been a little underserved is just super exciting. So yeah, I couldn't be more amped right now, man. I love getting on site and
Yeah.
seeing that action and activity.
Yeah, that 28-day plan is a big differentiator that we have here at Faris Capital Partners. As you know, John, our mission is to go full out for residents, provide the best living experience in the world. And a big part of that delivery is as soon as we take possession of an asset. And so that 28 days, the first 4 weeks, is a pivotal time to set the tone that a new sheriff is in town, so to speak.
Yep.
And it's an opportunity for us to come in and add a lot of value. So I love when the property management and Georgia on her team sends the reviews through from the residents. Like, I
Yeah.
can't believe it, but the leak in my bathrooms can finally get fixed, and
Yeah.
tears are coming, and it's phenomenal to see that
Yeah.
coming through. And you're right, like it's pretty cool to see that, and to see all those reviews and the insights from the actual residents. And it just goes to show that we're on track with this mission that we have. And the B class space, the hometown heroes, the nurses and firefighters and police officers, and they deserve a great living experience. And so we found that this market segment is very underserved, but the working class and the rental market is actually growing. And so affordable housing, not low income housing. So that's a
Right.
little bit different. So affordable housing, so where they're paying maybe $1,500 to $2,200 a month, this market segment is growing, but they're underserved in regards to being treated like we'll just say, a first class client.
That's
And
right.
so that's where it gets me real stoked when I see these. When I see the results coming through, that we're in alignment with that mission that we're on. And the natural byproduct of that, John, as you know, is they pay their rent. They pay more for their rent as well, because we're providing a better experience and better culture and more value in these markets that we invest in. We can be properly compensated, but the natural byproduct of that is our investors get the best returns. And so it really is a win-win-win all the way around.
That's right. And I think it's really a good segue into what we're going to talk about today. And it's why we like the single asset style of investing, right? Because we can very strategically choose a building, and then our investors have that same process they go through where they can select the investment that meets, sort of their needs and, kind of fits into their strategic wealth creation plan, right? And so that ability to make an impact at the property level is so much fun and very fulfilling, right? I mean, I think, both you and I have spent our entire careers in real estate, and when you see somebody that's, maybe not had the best living experience in the past, or maybe just not, the best experience going through the process, whether that's buying a home or renting a home or renting an apartment in this case, and solving for that. One thing I like to think about, and I always reminded myself of at my prior company and here at Faris Capital, is that moving is one of life's 5 great stressors, right? And so when you're moving your family, am I making the right decision? Is this the right school district? And then you just have the actual hassle of packing your stuff up and moving it. And you hear these stories where people show up on day one and their apartments in terrible condition and there's cockroaches running around and things like that. And so all these things we do with the 28-day transformation, with our property turns, just to make sure that it's a great experience from the first time they come and tour to the day they move into their apartment, all the way to the time that they eventually maybe move out, right? Maybe they buy their first home or they get relocated, whatever those reasons that they decide to move are, but just making that the best experience. It's really what motivates us. So anyway, I think that it's a good segue, once again, going back into why a single deal versus a REIT. So Mark, what's your take? Well, why do
Yeah.
you, or I guess we should start with the basics. Like, what is a REIT, right? And how does it work?
Yeah, so it's a real estate investment trust, and basically it's like a stock, but it's for real estate. So it's a pool of funds that you invest into, and it trades like a stock, so to speak, right? So you're getting, in many cases, you're getting a distribution of some sort, but then that stock goes up and down. And the advantage of it is that it's more liquid, so that for whatever reason, if an investor wants to sell, they can sell, but they're buying into a pool of different assets. And so that's why REITs were created. And then you have the single deals or the syndication deals, which would be in the same bucket. You go out and buy property on your own, or you come in as a partner where you get a partner like Faris Capital Partners, and you come in as a what we call them an LP or limited partner investor. But you're coming in as an owner with us, and so you're getting direct access to that deal, but you're getting all the upside, majority of the upside actually in that deal, just as if you were an actual owner on your own. And so the big difference is we're going to be diving into today. But what if at a very high level, one of the things that I realized was that at the peak of the market, there wasn't a direct correlation to how well and how high pricing was going up in real estate. When we saw these massive increases in real estate, we didn't see the massive increases in these REITs the same way. And so there's we'll just say there's less upside potential, and so you're paying for the liquidity side of it, and so you're paying for that. Whereas with the single purpose vehicle or the single deal, you're actually getting direct access, but there's much higher upside with that, rather than pooling with a bunch of different properties and a bunch of different investors on that end. So we'll be diving a little bit more into the differences, John. But I want to turn it over to you as to what your thoughts are of the two.
Yeah, I think for me, the thing that I struggle a little bit with REITs is that it is tied to the overall performance of the stock market, right? These publicly traded REITs, fairly or unfairly, right? And so if you see volatility in the stock market, it's not like REITs are immune to that, right? So as we saw when the tariffs were first implemented, there was a big sell off. And, you and I, Mark, I know we're more disciplined investors. Like, I'm all about planting a seed and just letting that tree grow, right? I heard this great quote recently when it came to investing and staying in the market, right? Time in market versus timing in market. You don't plant a tree and then tear it out every time the weather changes, right? You plant that tree and you let it grow for 30 years, right? And that's how I think about investing. It's a longer term play. And with REITs, there's great opportunity, and you get your dividend and the stock value goes up. That's great. But if there's a recession or a market downturn and there's a sell-off in the marketplace, all of a sudden the value of your REIT gone down, even though the properties might be performing perfectly. For example, interest rates go up and people panic, oh, that's going to impact these REITs. Well, maybe that REIT, is buying very intelligently with fixed rate debt, but the market responds to the interest rate news. So you basically are giving up a certain element of control when you're investing in a REIT that you don't lose when you invest in a single asset deal. So I think one of the key differences is in that control, right? With a single deal, whether it's the operator or the limited partner investor, you have an opportunity to really know the property, learn the market, get to know the operator, and have a deep understanding of the specific business plan. And so, for example, at Faris Capital Partners, our deal deck gets in all of the market demographics, the submarket, the school scores, the crime, population growth, economic drivers, et cetera. And then at the property level, what's happening, what's the actual business plan, and how does that business plan impact NOI? So, with a 30 to 45 minute, kind of review of the materials and then a little independent research, you can make an intelligent decision whether that's the right fit for you and your risk profile. Where with a REIT, you're buying, some shares in a fund, not a specific asset. And you may not actually always know where your money's going, right? Or what's the next deal they're going to buy or the deal after that, right? And maybe they start getting into industrial and there's a downturn in industrial, and your mind, you were thinking this was more about, housing or something like that. So for me, that control piece on what you're actually investing in versus the trust of hoping that that operator of the REIT continues to make great decisions down the line. That's why I like single asset deals. The deck, you see it, you review it, the comps, the plan. There's no black box here. You see everything. It's all very transparent when you invest in a single asset with Faris Capital Partners.
Yeah, 100%. So really, if liquidity is something that is really important for you and you like real estate, they can be a good potential. But at the end of the day, you're really paying for that. Just like uh, we'll say, compared to, you say you're buying the property next door, for example. Well, when you go in, you get to use leverage, and so you invest $1 and you can leverage something like 4 times greater or more in some cases, right? So leverage is something that's really good, because let's just say the market were to go up, say 10%. Well, uh, your investment goes up 10%, but if the market goes up 10% and you buy, say, $1 million property, and you're putting 20, we'll say $250,000 down, and the market goes up 10%, well, your 250,000 didn't go up by 10%. The million went up by 10%. Right. So you got 100 grand. So now it's what's that? 100 grand of 250. What does that work out to here, John?
Let me get my calculator out.
I got my calculator out here. I'm going to do I was like, I turned my phone off here before. So
That's 40%,
250,
40% growth.
40% return.
Yeah.
So
I
you
was
get,
about to yell out 40%, but I'm still a little, I have a little PTSD from high school because I was always told I was bad at math. And then I learned later, I'm actually not bad at math. I'm just bad at sitting here listening to you teach
yeah.
math.
I think that's the best part of the podcast, is you and I fiddle around trying to figure out what the percentage is.
Yeah. Yeah.
But the point there is you got leverage that you can utilize and
Yeah.
gain to your benefit with that. The other thing that's really good is that you get to know who the operators are, and so
That's right.
that is like a really big thing. Whereas a fund or the REIT is, you really generally don't get a chance to meet the main operator, the CEO, the president of the company, and you get to ask direct questions. That's actually one of the things that one of the reasons why we have 100,000 US minimum, is that we tell all our investors get direct access to us.
That's right.
And so there is a higher element, we'll say a better opportunity to screen the management and the main operators that are actually making the key decisions in the
That's right.
deal, which I think it speaks volumes, because otherwise, you got, say, a company, but like, who is operating behind the scenes and how well do you know them? So that is another factor when it comes down to it. And so again, if you're really going for overall returns and for the most amount of upside, but you're okay with holding the asset or the investment for 3 to 5 years, just like you would with an investment property,
Right.
right? Then, and you want to maximize your returns, the single family or the single deal investment will net you higher every time, especially if you operate it with efficiency. But the REITs, it's more about liquidity. So let's just say on average you're getting, say, 6 to 10%. Well, with the assets that we're doing, they're like, our average is 20%. And so Again, main reasons for that is that the types of assets that we're going after, the value add approach we're going with, force appreciation, the operations team, and then the fact that this is B class assets that actually have strong upside, where we're not going in and buying stabilized A class assets where it's more about appreciation.
Mm,
For example, here's an example. So I hired a property manager, and he was starting to tell me he had worked with a REIT in the past. And so what they did was, he said, Mark, what they do is they'll buy a value add deal like we're buying in a holding company or a separate corporation. They'll buy it and then they'll renovate it, and then once it's renovated and the increases the net operating income and the overall value, they'll actually sell it to their own REIT. And
mm,
so the retail investors get the stabilized asset, but they've scooped off the top with the gain in value. Which for us, one of the things that John, you and I, one of the reasons why we created this is so that we can help build investors net worth and
mm.
overall higher returns, and to get them access to real estate deals without putting in the time, but to
Yeah,
still get that same strong upside in these deals. And
yeah.
so that is that's a big thing that you got to really factor in. If overall returns and you're okay with the 3 to 5 year time frame, and you're going for overall returns, and liquidity is less of a thing, that's going to get you there a lot easier based on the structure and then the overall types of deals that we go after.
That's right. And I think too, an investor, right? I mean, the word diversification, right? It's you hear it whenever anybody's talking about smart investing. And so it's not to say you shouldn't have any money in REITs, right? I mean, I personally do, right? And if you actually look at like say the Russell, index or the S&P, like you actually do a deep analysis, and what you'll find in a given year, generally about 7 or 8 stocks are largely responsible for most of the gain. And we're seeing that today with stocks like Nvidia and Apple and Tesla, and some of these tech stocks, these high flyers, the AI are driving a lot of the market performance. And so it's not to say you just go invest in those stocks, right? The best investors invest in a variety of stocks across a variety of industries, right? You got your income, your growth, international, maybe some cash flow stuff, maybe some bonds, right? Some REITs. But when you're thinking about, wealth creation, you should be thinking about real estate, because it is one of the clearest and best paths towards wealth creation. And you touched on some of this, right? But that cash flow and return structure in a single asset deal, that strategy that REITs utilize, there's nothing necessarily wrong with that. But what they're doing is they're scraping something off the top, selling it back to the own REIT, and you're getting, yes, that stabilized cash return. But with a REIT, you're typically getting a fixed dividend, and you're not participating in the back end equity upside that comes with the eventual sale or refinance, right? So, it's great. You get your stabilized cash flow. You can count on that money coming in, assuming the REIT continues to perform and they don't have a catastrophe or down buildings or something like that. But in a single deal, we're offering number one, preferred returns. So our investors get paid first before we do. So in our world, we have an 8% preferred return. So the investor sees 100% of the first 8% of the IRR return that we generate. And then beyond that, it's a 70-30 split. Now, sometimes we have another waterfall structure at 15 IRR. But the point is that we align with you when you invest with us. In other words, we don't win until you win. So you're already getting great returns, and then that 70-30 split comes in. And then on top of that, this is a little something unique about us at Faris Capital. Other operators do it, but at Faris Capital, myself and Mark, and frankly, even some of our team members, like Georgia Patron's a great example, our asset manager, she personally invests in our deals as well. So we have our own financial stake in these opportunities. So once again, we're incentivized in many ways to perform, right? Number one, we're putting our own capital on the line. But number two, if we just produce okay returns, candidly, the company's not going to make a lot of money. So we have to make sure we're buying the right kind of deals that'll deliver those 20% returns that we're projecting. So our investors win big, and then we win a little bit as well along the way. So I think that alignment is so critical when it comes to that single asset investment versus a REIT. It's not to say REITs are incentivized against you, but at the same time, that alignment is so strong on the single deals that it's definitely something we're taking note of.
Yeah, right on. Yeah, and one other thing just to verify as well is that for tax purposes, that it's from a maximizing the amount of money you put in your pocket. you want to be able to look at if the REIT is two things. So return of capital. So the way that we structure distributions is return of capital. So you're not actually paying taxes during the whole period on your cash flow deposits that we make in your account every month from overall cash flow from the property. And then the other side of it, when you sell, if it's a capital gain or not. So in our assets, after we sell in 3 to 5 years, so there's no tax during the whole period because you're kicking the can down the road. So it's return of capital or all the distributions. And then when we sell the asset, all the profit is taxed at it as a capital gain. So that means only half of the total gain. Let's say you invest 100 and it goes to 200,000. Your overall gain is $100,000, but it's only taxed at half of that. So $50,000 is taxed your regular income level. Whereas some REITs, they're actually charging you as an income amount. So you just want to verify that from a tax standpoint, you're comparing apples to apples, because making an X amount of return is really great. But if you can put more money in your pocket getting lesser returns, right? Like that, then, it's how much money you put in your pocket. And so if you get higher returns and more money in your pocket, that makes it like a grand slam. And that's how we structured our deals so that not only investors protect their downside, they maximize their upside, but they maximize how much money they put in their pocket. Not to mention all the bonus depreciation and cost segregation to be able to mitigate taxes even further than that,
That's right.
right?
That's absolutely, yeah. So for our Canadian investors, you get that depreciation. In the U.S., we do have some more favorable laws, but what one of the benefits is that even with the money we're investing in the renovations, the depreciation we're able to take, when you get your K1 or your T5013, you might even show a paper loss even though you're cash flow positive, right? So from a tax benefit perspective, you get that. With a REIT, you don't. You just get your, kind of returns, right? So definitely something to consider. We touched on this a little bit. It goes back to just the volatility, right? REITs are traded like stocks. Therefore, things like headlines, interest rate chatter, or macroeconomic fears can impact the value of that REIT's share cost or that stock value. With direct real estate, yes, the market could experience, some tailwinds, or
Yeah.
maybe a manufacturer or something goes out of business and there's some losses of jobs in the area, but it's insulated from daily market swings, right? So it's why when we invest, we're very strategic on where we invest, where population is going to grow, job growth is there. And then we always touch on this, but it's the most critical factor. It's that diverse employment opportunity. So we're not investing in Detroit where, candidly, Mark, I can make a case, probably not a bad time to invest in Detroit right now. But what I can't tell you is what's going to happen in 3 years, because Detroit is just a boom bust market. And so even though there might be some short-term opportunity there today, we would not invest in that market because we can't guarantee what will happen in 3 or 5 years. But when we look at markets like Atlanta, Charleston, and Tampa, where we're seeing so much more in-migration than out-migration, relatively affordable cost of living compared to other U.S. states, and once again, economies that in governments, frankly, that are attracting business. So, if I think about Georgia, I mean, we have major manufacturing coming in from Rivian and all these, massive job creators that are supplying 10,000 jobs. But just a very diverse economy. So that helps divorce it a little bit from the market volatility of just the macroeconomic headlines or chatter, or somebody posts something on Twitter and next thing stocks go down 5% the next day or something like that. Cash flow is not emotional, it's operational. And so we're able to influence the operations to therefore drive that cash flow.
Mm-hmm,
Um,
mm-hmm.
so it's really something that each individual investor is going to have to decide for themselves. I think REITs are great for somebody who is looking for that liquidity, that wants some money that if something comes up or they see an opportunity to buy a vacation home, they can cash out and go do that. But somebody looking to build wealth and cash flow needs to be thinking about single asset investments where, once again, you're planting a seed and growing a tree and growing long-term wealth.
Mm-hmm. Yeah, well said. Kind of like bamboo. It's interesting with
Yeah.
bamboo. The
Yeah.
way it grows. Like I think we've chatted about it, but bamboo, the roots take like 2 to 3 years to grow bamboo, and so
Yeah.
it grows under, and you don't see it growing on top of the soil. And so it's growing underneath, growing. All of a sudden, it shoots up, and it can grow like 2 to 3 feet a day.
Yeah.
bamboo. I had no idea. And that's kind of like what real estate is, because you're building, the base, you're doing your renovations, and all of a sudden you get these, like, boom, you get these big, these big returns.
Yeah.
That's where, when you're buying a single property on its own, that's where you see the most amount of upside, of those roots taking deep when you first buy it. And then you see like these large returns in the next 3 to 5 years. And then final thought on this, John, is that in a REIT, you don't get to see the end user. You don't get to see the residents. You don't get to feel the emotion of the impact of your business plan and so in a positive way. And that this is where one of our mission is to go full out for residents, provide the best living experience in the world. And so we share those experiences with our investors of the impact that we're making in their lives.
Yeah.
And so this is something that our investors really truly feel part of the process, and they're getting that benefit that they are making an impact in these people's lives. And so that I get a kick out of that, John, is when I'm
Yeah.
seeing these reviews coming through, and at the end of the day, in a REIT, you wouldn't get to see that. It's kind of like it's an overall portfolio, but you don't get to see who the end users are. Whereas with us, we post, reviews, and they see pictures and our events that we do for them, which it impacts the overall feeling of the investment, which I just think is just a bonus. Ultimately, you want to get really high returns, but if you can get high returns and make impact in the world, that makes it like another grand slam. I said that's my
That's
second
right.
time I said grand slam today. So hope that was valuable, guys, that you got a good understanding between a REIT and a single real estate deal, whether it's in syndication or you buy it on your own. One's more liquid, the other one's higher returns. And again, hopefully that was valuable for you. If you did like the show and you want to learn more about the what we're doing and the types of assets that we're going into, go to fulloutinvesting.com. You'll learn a little bit more about what we're doing, how we're doing it, and there's a sample deal on there as well. So thanks again for listening, guys. We love you guys. And you can go ahead and share the channel with any other investors you think you'll benefit from it. We love and believe in you guys. Keep dreaming and investing big.